So medium to long term, I have a generally inflationary outlook. I think this is on average going to be a more inflationary decade than the prior decade. But just like other inflationary decades, I think there will be higher periods and lower periods. There will be recessions, contractions, maybe more disinflationary types of periods within that structurally inflationary type of decade. In terms of fiscal stimulus, we do have a risk of seeing gridlock for the next couple of years. It's potentially going to get more gridlocked. And generally, if you have a blue president, red Congress, that's among the various combinations you can have. That's basically the more gridlock type of environment. Usually, it's more gridlocked than the other way around. Usually, and it's also more gridlocked than if you have alignment, one way or the other. So that's an interesting risk if you go into a pretty weak environment and you have a fiscal gridlock that it's hard to get anything constructive through. If we zoom out really big picture, I think that one thing that I use when I describe the long-term debt cycle is that it kind of comes in like a 1-2 punch. There's a disinflationary private debt bubble that kind of pops, and that's it's a more structural popping than your typical recession. So that examples with that would be the 1929 crash and then the subsequent early 30s depression, as well as the 2008 pop, and then the whole basically a good chunk of the 2010s decade was a slower growth type of environment. And those are, you have a big disinflationary, sometimes outright deflationary, private debt gets partially liquidated. You have a period of disinflation because you have commodity oversupply. You're running at below prior trend economic growth levels. Generally, those types of environments have rising populism and just unhappiness as people are frustrated with the economic environment. And then obviously whenever you have a zero-sum game, you're gonna get also more international conflict or more just kind of changing order of how things are structured. And the problem there is that after a long enough time frame, when you have the combination of economic malaise, rising populism, and you slowly start working out that commodity oversupply or that capacity oversupply, you start to kind of get into a more inflationary type environment. And the catalyst can be could be a war, could be a pandemic. Obviously, the catalyst can differ, but since you already have a fragile system, you're then prone to get a lot of fiscal, and that's the more inflationary. That actually brings broad money supply up a lot quicker than just say monetary stimulus alone. And then also because you don't have that commodity oversupply anymore, you haven't invested a lot into new commodity production, you have pretty real supply side constraints since you have a more inflationary type of environment. And so for that reason, I've kind of used and then you have more of a public debt bubble as opposed to a private debt bubble. And so I've been using the analogy that in many ways the 2010s were a lot like the 1930s, less severe, but similar. And the 2020s are a lot like the 1940s so far. The initial pandemic financing looked a lot like wartime finance. And of course, now geopolitically, we have some degree of actual war happening, fighting over basically a zero-sum pie in terms of commodities and just resources out there. And so I generally view this as the more inflationary stage of that long-term debt cycle kind of unfolding. And that's what kind of marks this part of the cycle is an unusually wide gap between interest rates and inflation on a pretty persistent basis, because when you have that much debt in the system, generally some degree of currency devaluation is how it's handled. Yeah, I think it's going to be a long repricing cycle. And I think the one of the most blunt ways to put it is that when Japan has 250% debt to GDP, or Italy has 150% debt to GDP, or even the United States has 130% debt to GDP, you're kind of past the point where you can have positive real rates structurally. Basically, when you just run the long-term math on that, historically, whenever public sector gets that indebted, those bonds don't realistically get paid back fully in real terms over the next, call it 15 years. If it's an emerging market, you're likely to default, restructure in some way. If the debts are all in your own currency, you're likely to dilute it to some extent with money printing. Because if you have a very high debt to GDP level, either public or public and private combined, they're kind of you can either reduce the numerator, which is defaulting or reducing the debt somehow, or there's the denominator. You can increase the currency supply quite a bit, increase nominal GDP, mostly through the inflation component, while doing some degree of financial repression holding rates below the inflation rate, and that's how you essentially restructure some of the debt. Everyone kind of gets a haircut, and if they, in their kind of dream scenario, they do it on a gradual basis. It's not disorderly, and there's some examples of that in history. Often it turns out more disorderly by some points, and I think that's essentially the playbook, but it's just politically unpalatable, and different jurisdictions are going to handle that in different ways, because it's obviously, when you have mandates to have price stability, but you're in an environment where you can't possibly have structurally positive real rates indefinitely with that much debt in the system, you kind of have that impossible job. And so I think that it is going to be a pretty challenging and awkward decade for central banks to navigate, because they have to, on one hand, assert that they have this under control, that they're going to act responsibly to maintain price stability. But on the other hand, going back up to positive real rates essentially puts those economies into recession, that the debt just no longer works. It becomes untenable in that sort of environment. As you bounce back and forth between, do you want recession or do you want deeply negative real rates, or both? Because you can't really have neither. And so I think that different jurisdictions are going to navigate that differently, right? So I'm for example more concerned about Europe than I am about Japan, although obviously both environments have significant risks. And so I think that's going to be probably a key theme this decade, is the political turmoil, the market challenges of these policymakers trying to navigate this inflationary environment without some of the tools that we normally think of, that they would have to employ, that they even employed, for example, back in the 70s when debt was super low. They could raise rates super high, and just today they're in kind of a similar environment but with fewer tools. So right now, I think we're witnessing kind of a feedback loop that's not very favorable, because the challenge is when we have a very strong dollar, especially when it's rising quickly, that puts pressure on the whole offshore dollar market, right? So, depending on what source you look at, let's call it the BIS, for example, the Bank for International Settlements, they estimate that there's like $13.5 trillion worth of dollar-denominated debt that's in offshore markets. And all of that represents demand for dollars. And it's often, people might think of that as debt that's owed to the United States, but it's actually mostly not. For example, entities in Europe, Japan, China will lend money to other markets, and it's owed to those other sources, but it's denominated in dollars. And so whenever you have this kind of global slowdown, you generally get pressure on that market, because that's reliant on dollar-based cash flows, trade. And if they're squeezed in various ways, they have trouble servicing those debts. That all that debt represents demand for dollars. And so you generally get a stronger dollar, and it becomes self-reinforcing because a stronger dollar squeezes them, then they need to get more dollars to cover that. And so generally what that leads to is the foreign sector selling U.S. assets to get dollars, because although the foreign sector has a lot of dollar-denominated debt, they also have a lot of dollar-denominated assets, because the United States has run decades of structural trade deficits, something like $14 trillion of accumulated trade deficits since the 70s. So we have a deeply negative net international investment position. Other markets own large swaths of U.S. treasuries, U.S. corporate bonds, U.S. stocks, U.S. real estate, for example. Some of that's more liquid than others, obviously. And generally, when you get the dollar going up pretty rapidly, for example, you start to have the foreign sector either stop buying treasuries, or in some cases outright selling treasuries to get dollars. And that starts causing illiquidity and problems in the U.S. financial market. So ironically, a strong dollar, if you map that onto U.S. corporate profits, or U.S. treasury market functioning, or U.S. economic performance in general, that kind of ricochets back and hurts us, because we're in this very interconnected world, and the way we structured the global monetary system, it kind of comes back and hits us. So I think that right now the market is basically telling the Fed that they're not at the point yet, but they're getting close to the top of the range that they can tighten before it starts breaking things. So we already see, yield curve has been flattening and inverting. We're seeing, super low consumer sentiment. We're seeing illiquidity generally and high volatility in the treasury market, and in bond markets in general. And a lot of that, I think, is a function of the strong dollar. This kind of untenable gap between the dollar and some of our peers is kind of coming back to also hurt the U.S. I think obviously what gives the U.S. a lot of strength right now is the fact that we are more energy secure than, say, Europe especially, but also Japan. And so we have a number of strengths, but the dollar being strong is not necessarily indicative of good U.S. performance, it's ironically kind of circling back to hurt us. And so it's one of the things to watch, because that can dictate how long the Fed is able to hold a very tight stance, how high they can raise rates, how long they can do QT for, that types of things. Because one of the constraints that affects it, in addition to U.S. recession, is that Treasury liquidity.